All right, let's talk about gold. Now, we see it everywhere, right? In jewelry, electronics, but we're going to look at it through a totally different lens today. We're not talking about a shiny metal. We're talking about the most enduring form of money this world has ever seen.
But let's start with a question. I want you to think about the money sitting in your bank account right now. What is it really? Can you hold it? Or is it just a promise from your bank to you? This one simple question is at the very heart of why we even need to talk about gold in the first place.
You see, throughout all of history, there have really only been two kinds of money. On one side, you've got money that's backed by a hard asset. Think of it as a claim check for something real, like gold. And on the other side, you've got what we all use today, fiat currency. It's not backed by anything physical. Its value comes purely from the trust we have in the government that issues it.
And this massive shift to a fiat system didn't happen overnight. For a long time, money was tied to gold. But then you have these key moments, like in 1933, and then the big one in 1971, that just completely severed that link. The whole world moved to a system based on promises, and that fundamentally changed all the rules of the game.
And that leads us to the billion-dollar question for today, right? In a system that's literally built on trust and promises, what happens when those promises, all that debt, just gets to be too much? When governments, companies, and people owe way more than they could ever realistically pay back? Well, if you're a central banker, you're basically staring at two choices. There's the hard path, you stick to your promise, which means defaults, bankruptcies, and a really painful deflationary depression. Or there's the easy path, you break the promise. You just create more money to pay off the debts. The catch? That devalues the currency for everybody. And you know, when you look at history, they almost always choose the easy path.
And this, right here, is where gold re-enters the conversation. This is the core idea from our source material. Gold is so valuable because it exists completely outside that system of promises. It's the one form of money that's incredibly resistant to being devalued by a printing press or just straight up taken away.
And look, this is not some new, radical idea. History is literally a graveyard of paper currencies that were printed until they were completely worthless. And through all of that, across countless empires and civilizations, for thousands of years, gold has just quietly held its value. It is the ultimate survivor.
Now, if you think this is just some fringe idea, get this. Look at what the most powerful financial players in the world are doing. Central banks, the very people who manage our fiat currencies, hold gold as their second largest reserve asset. Think about that. When the managers of the system are hedging their bets with gold, that tells you everything you need to know.
Our source has this fantastic term for it, tough money. This isn't just about what it's worth, it's about control. Tough money is something you can physically hold, something that doesn't need someone else's permission to be real. It's secure in a way that a line of code in a bank's computer just isn't.
And this really gets to the core of what makes gold so, tough. It's hard for governments to just take it. It can't be deleted in a cyber attack. Its value doesn't hinge on a bank staying open or a government keeping its promises. And in times of chaos, whether it's a war or a financial crisis, that physical security becomes unbelievably important.
Okay, this is probably the single most important concept to get your head around. A stock? That's a claim on a company. A bond? That's a loan you made. Even the cash in your bank account is technically the bank's liability, it's their promise to pay you. Gold is different. It's just an asset, period. Its value doesn't depend on anyone else staying solvent.
Okay, so that's the big picture, the why behind gold. But what does this actually mean for you as an investor? How do you take this powerful idea and make it practical?
You've really got two ways you can go. You could try to be a tactical market timer, trying to jump in and out, buy low, sell high. The source material is pretty clear. For most people, that's a losing game. The much smarter approach is a strategic allocation. That means making gold a permanent piece of your portfolio for long-term protection and balance.
So, how much are we talking about? The recommendation is to think about holding somewhere between 5 and 15% of your portfolio in gold. So we're not talking about betting the farm here. It's about setting aside a small but meaningful slice for its unique protective qualities.
And let's be super clear about this. The point isn't to get rich quick if gold has a big rally. The whole point is to own a financial hedge. Think of it like an insurance policy against those very real risks of currency devaluation and financial instability that we've been talking about.
Now, this might seem a little weird at first, but this chart is so important for setting expectations.
Over the long run, gold's real return is pretty low, about the same as cash. And that's exactly the point. It's not a company making profits, it's a store of value. Its job isn't to make you rich, its job is to keep you from becoming poor.
So if you only remember one thing from all this, let it be this. Stop thinking about gold like it's just another commodity to bet on. Start thinking of it as a fundamental type of money, a piece of our financial DNA that still has a crucial role to play. And it's probably something you should own at least a little bit of.
Which really leaves us with one final thought to chew on. In a world that is built on promises, where money can be created from thin air and debt levels are higher than ever, could it be that this ancient yellow metal is actually the ultimate financial insurance policy?